We are here to talk about securing your succession plan and navigating during a higher interest environment and also post-pandemic. So hopefully that's what you thought you were getting yourselves into, because that's what we're going to be talking about today. I'd like to introduce myself. My name is Ray Lampner. I am a partner with the firm. I can say now that I've just finished my 30th year in public accounting, so it makes me feel really old, but that's okay. But I specialize in the CPA consulting side of the business, and Tom and I jointly lead the succession planning practice. So Tom, if you want to introduce yourself.
Morning, good afternoon, everyone. Tom Bayer. I'm in the Indianapolis office of Sikich, and I'm just a little bit ahead of Ray. I'm getting ready to finish my 31st year in public accounting in January. So it's been fun. And I too, like Ray, work a lot in the advisory and consulting side of the business. Do a lot of succession planning. And with that, some tax planning, long-term tax planning, which is obviously a big part of the succession planning process, but not the only part. So welcome to our webinar today, and thanks for joining us.
All right. So I'm going to take care of a few housekeeping items before we go ahead and jump into it. For those of you that are looking for CPE today, the next slide is going to tell you how to get into it, but just so you know, there are going to be 3 codes that's going to be necessary for you to put in. Kind of going through with those codes. There are also going to be polling questions. The polling questions are informational purposes. They're not necessary for the CPE. So if it doesn't apply for you and you're not comfortable answering, don't worry about it. We just need the codes. So you can either scan in the barcode there you see on the left-hand side if you want to do that on your phone, or there is a website up above that's highlighted in red. If there's any issues today with either getting logged in or you're having a problem, go ahead and go through the question feature on your control panel to see if we can get that rectified. But don't worry, if for some reason it doesn't get worked out during the thing, just make sure you get into question and they will follow up with you afterwards to make sure everything gets taken care of. If you have any questions during the seminar, please go ahead and post it in the question box, and we will try to answer as we go. If we don't answer, we will respond after the webinar today. Also, the handouts are included. You can see them on the control panel there for you to take a look at. And also, we are going to be recording this session, and it will be available on demand afterwards. So I'm going to go ahead and move to the next slide. So real quick, in case you didn't get the scan code in there, it's up there again, but the first code is 556. This is going to be the first of 3. I'll give everybody just a couple of seconds here to make sure you get that in. Okay, and again, if you're having problems, don't worry about it. We'll just go ahead and log into the questions and let us know you're having a problem. We have a disclaimer here. Tom and I are going to be talking about a lot of things today, and we really don't know about your business, so we're just talking in generalities. So this is just saying that make sure if you're going to do any of this and you make sure you get professional advice or somebody that's familiar with your company to do that. Hopefully you think about Sikich when you do that, but if not, we still highly recommend you do get somebody involved to help through the process. All right, I think that is the last of the housekeeping items. So as far as what we're talking about today, Tom and I are going to kind of be going back and forth. So he's going to speak first about what is business succession planning. Then I'm going to jump in and talk about the evaluation of the current business environment, and then also talk about current valuation trends and multiples. Then after that, Tom's going to get back into it and talk about management and key retention strategies, and also tax planning and structuring. So that being said, let's go ahead and jump into it. We have our first poll question.
Okay, our first poll question today is, in how many years do you anticipate exiting your business? And so less than 2 years, 3 to 5 years, more than 5 years. So we'll give you just a second here to answer that, and we can publish the results. We'll keep it open, and I'll let one of our professionals tell me how we're doing in terms of the number of folks that have responded.
Yeah, one thing to keep out too with the poll question is a lot of times we ask our clients have this conversation with our clients because we're hopefully getting it in ahead of time, and there's some things that maybe take a couple of years to get up and get going. So if you're planning on being out in 3 to 5 years or 4 years, you really want to get started with your planning well ahead of that.
Okay, let's go ahead and close the poll and see what kind of results we have. Okay, less than 2 years, 16%, 3 to 5 years, 26%, more than 5 years, 58%. Sort of interesting to me. It's a rolling, my experience with this is it's a rolling 5. So if we ask you a lot of business owners in 2 years, the same ones that said, 5 years 2 years ago are going to say 5 years 2 years from now. So it's so that's really kind of in line with what we've seen in the past. So it's a difficult thing to wrap your arms around to start to think about succession planning. And with that, let's talk about it. We got a couple slides in here on what exactly is succession planning. So one of the things we want to emphasize is it's really a team sport, and requires probably more than one professional. A legal professional, a financial advisor. If you're going to sell the business to a third party, it's probably going to involve an intermediary, investment banker type person. You may need some HR consulting to help you with some key employee agreements, and you might need an industry consultant as well. So it's really a facts and circumstances decision, but the point here is that our role is really to help quarterback the process, and obviously we can insert our expertise where we have that, and where we don't, we want to try to connect you with the right professional to help move forward with the succession planning process. Next slide, please, Ray. There you go. So real quick, these are the 5 questions we try to answer in the planning process, okay? And the first one, it really applies to a business owner, whether you're 2 years away, more than 5 years away, or 25 years away. The question is, are you ready? Are you ready for the unexpected to happen? Because many times business owners exit in a fashion that they don't expect, right? They may have a disagreement with their partner. They may have an unfortunate event. I don't really like to talk about those. What I like to talk about is there's a surprise offer that comes to you, and it's more money than you ever thought you'd be able to realize from the business, and you want to accept that offer. And the question is, are you ready to execute on that? And that involves a lot of, do you have the right agreements in place? If you have multiple shareholders, does your shareholder agreement address those things? So are you ready is really something that I would encourage all of us to think about, regardless of our timeline toward exit. Second question is, who is the successor? And I put on here that the successor owner may be different than the successor leader, right? I mean, it could be that we transition ownership, but retain some of the key management team to run the business in our absence. So that doesn't necessarily have to be the same entity or folks. How much does the business owner need to retire? That's really a 2-part question of how much do you need to retire, and looking at all of your assets and your wealth that you've accumulated, not only from the business and what the business might be worth, but outside of the business, your retirement plans, your investable assets, real estate, anything else. So it's really important for us to go through a personal planning process and really determine if we can retire the way we want to retire, we can achieve the goals that we want to achieve in retirement. And a lot of times we may have a gap, right? We may have a gap of what we think the business is worth and how much in assets we have versus what we need. The fourth question is a when. When does the business owner plan to transition? We had that poll question, but when is an important thing to think about and try to work toward. And lastly, what is next? Maybe the most important question of all of these, and that's really about the business owner, removing themselves from the identity of the business and being ready to move on with the next phase of their life. And it's difficult. Ray and I have been in public accounting for 30 plus years. It's difficult to think about what life looks like next, and we're no different than any other business owner. So that's something that's important to look at. Ray?
All right, cool, thank you. So I'm going to talk about the current business environment, and it's kind of interesting that we're doing on today where the stock market's shooting up and everything's up 2.5%. The Nasdaq's up over 2.5% or almost 3%, and a lot of times when we're talking with business owners, they're trying to time the market and when is the right time to go. And as you can see, there's never like a right time. It's just more when are you ready to go, and that's kind of what Tom was getting at, kind of his conversation there. So. Tom had the privilege of a few months ago speaking to a group of technology business owners, and during that he asked them kind of what's keeping you up at night. Now I noticed on this one the supply chain challenges were light, and it's probably because of the industry that they're in going through. But their two big areas are going to be growth, which in that industry is huge. You're always looking to grow or and always change and go into new markets because, quite frankly, there's just things that go away at certain times in the technology business. The other thing that they brought up was access to talent. So you can see that there's still, even though we're a couple years removed from COVID, we're still kind of going through some of the same issues that we were, pre-COVID and definitely during COVID going through. So what are we seeing right now out in the market? And you can kind of see from the graph on the right that when you're looking at the deals that have closed during 2023, that they're down significantly over the past couple of years where they're at in the activity that's going on. So really what's going on right now is that with a lot of sellers, a lot of them right now are feeling like maybe they missed the boat by not selling during that time period, kind of going through. A lot of the sellers had deadlines which made them need to sell during that time period, and why it was really busy during that time period. A lot of that has to do with private equity firms and things like that, where they have to do a return of capital going through there. We're also seeing the interest rate increases. Obviously, that's probably everyone on the call is perfectly aware of them that you're going through, and that's kind of what's causing a big part of the slowdown right now. Obviously, if you're a financial buyer, it's probably more apt on the smaller end of things. The way you pay for the company, a big part of it's going to be the cash flow of the business. And so when you're using more of that cash flow to pay interest, there's less that you can pay on the company. So valuations are dipping because of that. Credit tightening, a lot of banks are cutting back on some of their exposure in different industries. And less likely to be aggressive on deals that they're doing. A lot of the slowdown just is the general economic and political uncertainty that's going on. I mean, it's in the news every single day. And I know we're fighting right now with trying to get the budget passed. So we'll see how that goes. But the good news is things are turning more optimistic. So we have a transaction advisory services group that specializes in people are either buying business or selling a business, specifically doing the due diligence for that. And about 10 years ago, you didn't really hear much about people doing sell-side due diligence, which is basically helping you get ready for sale and making sure there's no issues when you go through the process. But over the last few years, it just has become more and more commonplace, and it's almost a given now that you're going to do that. I know we're seeing a huge pickup in that activity right now. So we're seeing a lot of businesses that are looking to go to market in the first quarter of 2024. So like I said, we feel, who knows what's going to happen, but all signs for us right now are pointing towards 2024 looking like a good year. And so what are some of the reasons that might be driving that too? You know, the term dry powder, meaning cash that they have on hand, is at an all-time high. They don't make any money on that unless they actually go out and make acquisitions. And also at the same point, private equity firms are still at a point where, you know, when they buy a company, they have to sell it in 5 to 7 years. So they're looking at one point they have to sell it, and that time is coming. And again, they've had record fundraising for the last couple of years. So again, they have to put that to work. Right now, the valuations are on the low side, but we think those are going to come back in next year. And again, you know, we're seeing a huge uptick in companies getting ready for sale. We're hearing the same thing from investment bankers, that their backlog of potentials are growing and growing. Again, keep in mind, this is just a slowdown. It's not an end. This is the perfect opportunity for business owners to do what they need to do in order to find ways to increase the value of their business and getting it ready for sale. So what are some of the things that were causing issues, you know, in the business conditions? You know, the prime rate's at 8.5, inflation's at 3.7. You know, got some good news on that today, at least. Marginal tax rates are at 37, but in 2 years, if they don't change the tax laws, you know, we're gonna go back to almost 40% again. Capital requirements for banks are increasing, which when that increases, there's less money to lend. And then just kind of not knowing what's going to happen with the tax policy when it happens. So most business owners, when they kind of know what's happening, what's going to be happening in the future, or I don't know, as well as knowing what's going to happen versus knowing there's not going to be changes, that's when business owners tend to get more comfortable, and then they're more comfortable in doing the transactions. Unfortunately, we don't really have that right now, but again, hopefully that's going to be able to find some ways for that to settle down. So our view is we don't want people to get comfortable during this process and find reasons not to kind of push forward, because I think it's going to be a while before there's another rebound in the M&A market. Historically, it's 2 to 6 quarters, and so we're already a few quarters into it. So kind of what we're looking as far as first quarter 2024, seeing things pick up again, and the activity kind of fits right in the middle of that 2 to 6 quarter period. You know, winning more mandates. So that's what we're hearing from the investment bankers. So they're winning more companies that they're going to be taking to market. Private equity firms have excess capital, so they're looking to spend it. And the big thing too, private equity investment bankers, they live for their bonuses. You know, it's just honestly how that industry works, and they get bonuses by closing deals. So they're really looking to push that forward. And hopefully we're at a point where the uncertainty is plateauing, meaning hopefully we're either very near the end or at the end of raising interest rates. And what we're also seeing is alternative financing. So outside of just going to the bank and getting your traditional bank loan from the bank, you know, there's things like the mezzanine lenders are more active. Private debt funds are willing to invest. But we also see that traditional lending is, we do expect that to return. In some other areas that kind of are, you know, that businesses are facing, whether it's a risk or it's an opportunity, is something kind of to look at. So the green energy and sustainability. So specifically, we have under the Inflation Reduction Act. It's funny, I'm working with 2 different solar companies right now. One builds the large solar fields, so you see acres and acres of solar panels. The other one puts them on houses. The one that's putting them on houses is nothing but, you know, good times are to come. The credits are going to really help. When I talk to the one that's doing the large solar fields, their concerns are they don't actually make the panels, they just install them. You know, their concern is actually finding the solar panels, and they think there's going to be a shortage being taken up by things like doing the residences. So it'll be interesting to see what comes up with. The talent shortage is not an end of an issue and doesn't appear to be ending anytime soon. The move to robotics and business process automation. So that's something we talk a lot with clients. You know, a lot of times it doesn't make sense to make that investment right before you're going to sell. But if you can say, I can go out and buy some robotics or automate things, and I can make an investment and show how that hits my bottom line, you got to be able to prove how it hits your bottom line, which typically means you need 12 months of it hitting your bottom line, that's where you can really see some value when you do it. And then the same thing, artificial intelligence, we have intelligence, we have a lot of people looking into how it's going to impact their business. It's obviously still a huge learning curve on that. And then the last thing, the tightening of credit at regional banks. So hopefully, that's going to loosen up here in the very near future. So just some of the realities of what's happening with, current business succession planning. Higher rates are reducing valuation multiples for financial buyers. It's just, like I said, they've got their cash flow that they get from the business. The more that goes the interest, the less you can use to pay down debt. So that will lower the valuation. A lot of the uncertainties are just causing customers to delay investments. We're seeing right now a big impact of a lot of inventories purchased during COVID, and people are depleting their inventories down to historical levels pre-COVID and even below that. So that's causing a lot. It's causing a lot of drop in revenue in some companies. And then, get back to many baby boomers are delaying their exit. I started doing this type of work in the early 2000s, and the whole thing was the baby boomers are going to sell all their businesses, and there's going to be this huge transition of businesses. And a lot of that is going on, but it hasn't happened to the extent that I think everybody thought it was. And there's still a lot of people that are still holding on to their businesses. Obviously, it's everybody's own decision when you kind of go through that, but there still is a backlog of businesses that need to come through because of that baby boomer generation. All right, so the second code is 734. So for those of you that are looking to get CPE, go ahead and drop that code in. I believe, Tom, we have a polling question.
We have another poll question. We do. So, what do you think the multiple of your business is? So, just to make sure we understand the question, EBITDA is the term earnings before interest, taxes, depreciation, and amortization is kind of a standard term. A lot of times there's kind of rules of thumb. Well, it's a 4 times EBITDA or it's a 6 times EBITDA. So the question is, what, based on your industry, the size of your business, what do you believe the multiple, that EBITDA multiple for your business might be?
And so obviously we're going to get into, we have some charts and graphs to go through after this. So we'll kind of show you what's going on in the industry, and we have it broken out between different segments too.
Okay, let's go ahead and close the poll and see what how folks answered here. So less than 4, 41%, and then you've got a mix between 4 to 5 and 5 to 7 and more than 7. So I'll let Ray kind of go through, what drives that multiple for you, and, but that's an interesting mix.
All right. So a couple of things just I kind of want to go over before we jump into the graphs. Is one thing is, when a lot of times we're talking about multiples of businesses, but we also want to, what does that translate into value? So most transactions are done on what's called a cash-free, debt-free basis, meaning let's just say the 5 is the right number. You have, I'll say $100,000 with the EBITDA. That means your business is worth $500,000. Well, what that translates into, that's the enterprise value of the business. So if you have cash in the business, you get to keep that. And if you have debt on the business, you got to pay it off before it sells. And also includes, that price also includes your inventory and your AR. So sometimes you see people trying to add that on top of it, but that's already included in there. And the reason that's important is sometimes people don't think of the next step. So we use something that's called a net proceeds analysis. It's basically, okay, here's what your business is worth, but here's what you actually walk away with after you pay the bank back, after you pay professional fees to get the deal done, and then after you pay your taxes. And that's really the number that's important, to kind of do your planning around. But I just want to make sure I kind of got that out there as we proceed here. So like I said, we've looked at this in different directions. So this first slide is based upon the size of your company. And when you look at it, one thing we always talk to people is the bigger the company is, the bigger the multiple is going to be. And it's a general rule. when you look at that type of thing, just because there's more buyers. You're less than $1 million, you're 1 to 5 million, there's going to be less buyers for those types of business. As you get bigger, there's going to be more buyers, but there's also going to be bigger buyers that can afford to spend more money. So there's more competition for the deal. And this is also something we talk about, when we get into succession planning of, looking to grow your business. And so obviously there's, multiple ways to grow a business. Organic, sales, that type of stuff will grow your business, but also doing acquisitions. And so if you can, be in one bracket, let's just say you're in the $5 to $10 million worth of EBITDA, and it says you're trading around a 5. When you look at that, if you can do a couple acquisitions and say you're buying them at a 4 multiple, and then you get up into that 10 to 25 million range, and all of a sudden you're at a 6 multiple, you've really increased the value. So you're buying, let's just say, $1 million business, EBITDA at a 4 multiple. You turn around and sell it grouped in with yours, you're getting a 6 multiple for that same $1 million business. So that's kind of one of the things we talk to people about. Obviously, there's risk associated with it. So it's not like you do, I'm just going to buy a business for, the $1 million EBITDA. You need to make sure it fits and it makes sense to a potential buyer of your whole business. But at the same time, it needs to be a good, solid business. And then on top of that, hopefully you can find some synergies, which even increase the value more as we go through this. The next graph is it's going to be selling price by EBITDA. One thing I'll say, the source on this is BV Resources. They tend to focus on a little bit on the smaller side of transactions. I was actually a little bit surprised on the response of 41% thought the company was worth less than a 4 multiple. Normally, Tom, I'm sure you're going to agree with this. Normally, we're kind of talking to people, they think their business is worth more than it actually is. So I was actually kind of surprised by that. But I guess, it's all good. So one thing you got to remember too with these graphs too, it's purely a math equation. And so when you sell your business and they're taking this data in, if you sell your business for $5 million and your trailing 12-month EBITDA was $2 million, the number's 2.5, right? So it's 2.5 times the 2 gets you to the 5. But when somebody buys a business, they're really buying it on what they think it's going to do in the future. And these graphs and stuff don't take that into consideration. So that's why you see things like when you look at Q1 2022 and Q2 2022, why you're seeing things the same as a 2.9 multiple. Well, the next graph shows a little bit better, and I'll kind of jump into that. What happened in 2022? Well, if you had inventory, you were selling it at a higher price. The cheaper inventory, you're turning around and selling it. So your EBITDA margins on a lot of companies got inflated. And when buyers were coming in, the buyers weren't paying for what you did historically, you're paying for what you think you're going to do in the future, and there isn't an expectation that you're going to keep your EBITDA margins at that same higher level. So again, if you go back and look at the 2022 numbers, when you're looking at them, you'll see that, the EBITDA margins went up while the multiple went down. So the business overall didn't really change in value. It was really the composition of what you're looking at. So when you first see that, well, the multiples are down, that means the business values are down. It's not really a true statement when you look at it. It's just a matter of there was a concern that businesses were going to continue to operate at the profitable levels that they were at. And that's what happened within the multiple, kind of going through there. All right, so this graph gets into industries and where the multiples are at, and these are private targets. So no, not buying from private equity firms, not buying from publicly traded companies or anything like that. So you'll see that across the board, the first few on the left, they probably didn't have enough transactions in order to have real true comparisons. So that's why you don't see the numbers there for the last 12 months. But what this is looking at, it's looking at historical numbers compared to what's happened over the last 12 months. And you will see that there have been a few industries that have really kind of skyrocketed. There's consolidation in those industries. When you're looking at the information and the finance and the insurances, they have high multiples in those areas. But again, those are areas that are really consolidating when you go through. But again, when you start looking at it, this gets into the industries, and it's still a tough one, right? So I mean, you look at manufacturing business, and that's always a tough one because to sit there and say, well, this industry is manufacturing, that's what I should be valuing my company at. you're going to get into different things like, how capital intensive is your manufacturing business compared to others. You're going to get into things, like how stable is your income, how cyclical is it, do you have customer concentration? So there's all kinds of things that play into that. And that's all kinds of stuff that, you should probably be having conversations ahead of time, and how do you minimize and make things more consistent. In essence, you're looking to make it more profitable, more appealing to a buyer when you go through that process. This graph, and it kind of proves that they're looking at smaller businesses. So this is looking at different types of buyers for different types of entities. And you'll see the two lines at the bottom. One is private buyers and private sellers, and those tend to garner tend to be smaller transactions, and also tend to garner the lower multiples on a business, because private buyers typically don't have a lot of excess cash, and they're putting some money down, but most of the business is getting paid for from future profits. If you look at the top three charts of that, the top three lines, those include some public buyers and public sellers and different things. And you'll see that the multiples are much higher when you go through. Those also tend to be bigger transactions too, when you get into those kind of buyers. So it's not quite, hey, if I'm looking at 2022 and if I'm a private buyer, private seller, I'm looking at, looks like maybe 4.5 multiple. If I can just find a public buyer, it's going to be that much higher. I don't think that's a true statement, but there is, the more buyers you bring to the table, especially if you can get public buyers who are interested, it is going to raise the multiple of your business. And I think something also to kind of take from this, and Tom, you might be jumping in this a little bit later when you're talking about tax planning, is I do a lot of valuation work also. And one of the things we do for businesses, and if there's estate planning that needs to be done, is trying to get some of the assets out of the business owners so they don't have to worry about estate tax later. When we do a valuation, we're looking at it as though it's a private buyer, private seller. That's what fair market is. You're not looking for a specific buyer, specific seller. So that tends to garner a lower value in the business. And on top of that, it's, we can also use some discounts associated with it. I'm not going to get too much in the details, but that way you can get stuff out of your estate at a much lower value. And then if you turn around a couple of years later and you're able to sell at a much higher value, you actually save that much more estate tax. So it's a really good planning tool to look at when you're looking to move forward with it. All right, Tom, I'm going to turn it back to you to talk about employee strategies.
Okay, Ray, good stuff. Thanks for all that. What we want to talk about, I'm going to talk about have a couple more topics, and then we'll wrap up here. But the first one is key employee strategies. And you want to flip to the next slide there, Ray. If we start with just what's the value driver in a business, very generically, we'll start at the bottom. Ray mentioned earlier, investing in technology and AI. When you're getting ready or thinking about selling your business, I think that there's a tendency, or maybe this is lesser today than it was years ago, to kind of pull back the reins on new investment. And it really probably isn't a good idea, something you need to review with your advisors. But think about today, that there might be, we're maybe getting into a period where there's more sellers than there are buyers. And so you have the business that you're competing with a similar business in another market, and they've continued to invest in technology and innovate and try to build for the future. The buyers are going to be more attracted to that business. So I say that just to think about that as you think about the long-term exit of your business. Quality of information is critical. If you get a private equity group involved, they want to know the information's good. It can scare a buyer away pretty quickly if they start to feel like the information they're getting isn't good. Defendable or growing customer base. Ray mentioned customer concentration, always something to look at. If you're too concentrated in one customer, you're probably going to have some hit to value potentially. Access to capital or credit, critically important to try to manage growth, but also maybe you have seasonality in your business. You've got to have capital. You got to have a strong balance sheet. All these things are important, but probably most important and at the top, and one that we probably get involved in, when we do succession planning, it's always a topic, and it's always something we really delve into, and that's key employees. And generally those key employees are part of the leadership team. So we're going to talk just a little bit about key employees and how do we protect them, incentivize them to stay, so that that business value is retained. Okay, so what should we be looking for? What should, as business leaders, and then what should the key employees be looking for? Maybe these are some of the soft issues, but how do we define good performance? What does that look like? What's their future career path? Do they feel trusted and cared about? Do they have a development plan? I mean, has someone taken time to lay out a roadmap for them to say, this is where you're going, and this is the investment we're going to make in you? Maybe direct coaching and mentoring from leadership. It's the giving them time with you, talking about different decisions. It's really, that's part of the mentoring process. Giving them feedback, are you giving them direct and timely feedback on their performance? And then, lastly, a comprehensive total rewards package. I mean, are they comfortable? And is the package that you've offered them and they're benefiting from, is it competitive? So what does that mean? Well, we could have some tailored benefits, some executive perks, if you will. Maybe there's supplemental medical coverage, disability, life insurance. Maybe we pay for club memberships. Maybe we pay for some of their personal services. It's not unusual, as we know, for public companies to help some of their executives with some of their needed services, planning services, termination provisions, that they those are well defined. And then tax gross ups is the other thing. And if you're providing them taxable benefits and they're going to have to pay tax on those, are you willing to sort of gross those up so you effectively pay the tax for them, and put that tax into their W-2 so that they've covered that non-cash benefit? And then there's long-term incentives, right? So what I always talk to business owners about is, are they generating enough cash currently to have a comfortable lifestyle? That's first and foremost, because if you're not solving that issue, I think there's higher risk they could be looking around to solve that issue somewhere else. So, and then you get into long-term incentives, which is, trying to build up a supplemental retirement plan, but also a bonus plan, cash bonus plan. A lot of employers will do equity plans, whether it's phantom or options or restricted stock, and then non-qualified deferred comp plans are put in place with vesting provisions. All of these things are designed to make that employee sticky, reward them for their efforts. And here's a slide, and it's a little bit small. You might have to squint your eyes a little bit. I know I do, but what are some common performance plans? Well, or long-term incentives. Performance plans are the top one, and of that, long-term cash plans are probably the biggest category, with about 40%. So 2 out of every 5 employers provides that. And then you've got other performance shares or units that maybe is some sort of restricted stock. And then you've got stock options, restricted stock units. 42% of employers, they reward their key employees with that. And then we get into phantom equity, phantom stock, or stock appreciation rights. Again, all of these things, especially the stock or equity or synthetic equity, are really designed to, allow them to, grow their retirement fund as the company and the value of the company grows. So, these things are not without their complications. I mean, there's tax code that dictates the structure of these. You know, we have an HR group that helps companies with designing these types of plans. So it's something you need to, you know, have the right professionals to help you design the plans, but they're extremely beneficial when it comes to retaining key employees. Okay, and our last code, and that doesn't mean that you can just jump ship at this point, because we got to fill out a survey at the end for those of you who are trying to get CPE. So 332 is our last code number.
And just as a reminder, all the codes are in the chat function of the seminar.
I don't know, do we have another poll question here? Or?
We do.
All right. And so our last poll question is, and we're going to jump in. So that's kind of the end of our key employee section. We're going to jump into tax implications of an exit. So do you understand for your particular situation, what kind of tax implications exiting your business do you have? Can you quantify that? So it's just a yes or no question. And as Ray mentioned earlier, you know, the key here is not what the top line number is. What are you going to sell your business or sell your stock? You know, maybe you're a shareholder, one of many shareholders, and you're just selling. It's not the top number. It's really what do you net after all the debts are paid and the taxes are paid. So let's go ahead and look at the results here. Yes, we do. Okay, good. So 58%. And so my challenge to you would be, can we make it better? And that's what we're going to talk about. So I'm going to talk about a couple topics here that I think are really of interest. We see a lot more activity. I'll start with this, and I think Ray mentioned this earlier, you know, and I was just with a banker last night with a big bank here in Indianapolis, and we had this conversation about, you know, we really try to get business owners to take time to plan. And succession planning is not a one-time event. It's really, you know, something you really need to look at annually. You need to assess the, you know, current facts and current circumstances you're under. You know, if you've had turnover, if you had growth, if you've had changes in your family dynamics, all those things need to be reflected in updating documents and so forth. So, but for tax planning specifically, we need time. We need time to plan. We can't generally can't execute on good tax planning strategies if you've got an LOI that you just signed and now you want to figure out, you know, how to minimize your taxes. There are some things we can do for sure. I don't want to make you believe there's no planning yet to be done, but it can be a lot more beneficial if we have, you know, 3 to 5 years. Okay, so, you know, there's what I'll use the word, you know, soft item. There's the intangible items here. When we start to think about business structure, we really want to think about the ownership group, the stakeholder group. Are the owners a lot of passive investors, family members that frankly rely on the cash flow from the business? You know, is the business going to need to make some big capital investments in the next 5 years? You know, what are the cash flow needs of the business? If it's growing and, you know, growth means we need cash, we need to supply cash to support a growing balance sheet. So lender requirements, you know, if we're borrowing money or, you know, working capital or for, you know, long-term investment, we may have to consider, you know, the lender requirements and in the context of what structure we use. Clearly, tax efficiency is an important aspect, but we also want to think about exiting the business. What's the most likely path of exit for us, and what's going to be the most tax efficient structure for us to exit the business? And the last point I would make is we work with a lot of family businesses, and family or owner, non-family owner harmony is just a critical factor. And so what we don't want to do is tax plan our way into a structure that creates a lot of internal dissent or within a family or within an ownership group. So there's a lot of sort of intangible considerations that we need to take into account when we start to think about structuring a business or restructuring a business. Okay, I'm going to talk about two topics here mainly. I'm going to talk about qualified small business stock, which is an increasingly popular topic and strategy. And then I'm also going to talk about ESOPs, which is also a good strategy. So what is this qualified small business stock? Well, IRS code section 1202, it's not new. It's actually been around since 1993. And over the course of the last, call it 20 years, the code has changed. So initially when they passed this, you could sell qualified small business stock. You would get 50% of the gain excluded from tax, right? So at the time, the C Corp rates were prohibitive. It really wasn't popular. And then we had a recession in 08, and they rewrote the law and made it 75%. And then in 2010, I think there's a specific date, September 2010, it was changed again. It went to 100%. So C Corp stock that was issued after September of 2010, and again, there's a specific date that meets all the eligibility requirements. The gain or part of the gain could be, depending on the sale and the size of the business, could be completely excluded from tax, right? So it's a pretty powerful tool. So some very, very high level basics. You have to own the stock. It's got to be original issuance from the C Corp after September of 2010, right? So it's got to be something originally issued. And there's certain industries that don't qualify. Think about industries that add to our GDP, right? So excludes a lot of service industries like ours, excludes banks, excludes real estate investors, but a lot of industries, manufacturers, construction, technology, do qualify. So, and then there's some other requirements that in 1202. One thing to note is you don't have to sell stock to get the benefit of this. If we sell assets inside of a C Corp, and then we do a liquidating distribution, that liquidating distribution can potentially qualify for a 1202 exemption. So this is something we're evaluating more and more with clients. The question you have or should have is, I'm a S Corp today, I'm an LLC today, and I don't plan on selling for 5 years. Can I get there? Can I take advantage of this benefit? And the answer is maybe you can. Just remember that the value of the business today, we could get you to a C Corp and get you that holding period. The value of the business today will not be excluded from the gain. So it's got to be a business that's going to experience a significant increase in value for it to make sense for us to do that. But it's a powerful section of code, and like anything, it could be changed. Congress could come along and remove this very powerful tax opportunity. Ray, you want to?
I did advance. Not showing.
Oh, here it goes. Okay, sorry about that. Did we flip over to? I can't remember. I know we're getting close to the time here. Go back one.
No, you got it's 120.
Okay.
So you
Okay. 10 minutes. All right. So let's talk about ESOP. The last thing I'll say about the 1202 is because the tax rate went down in it was at the top of that slide in 2018. Really is what's created this as a real opportunity now because C Corp tax rates are so low. Let's talk about ESOPs real quick. There could be intangible benefits as well as tax benefits to owner. to make this a very attractive option. What are the intangible benefits? Well, everybody's an owner, right? Employees that are eligible, that meet the eligibility requirements, are now owners. And so part of their retirement benefit is tied to how well they perform their job. That's the idea. They're qualified plans regulated by ERISA. There's special advisors that you have to hire, a valuation firm that can do ESOPs. There's only certain firms that can help you put ESOPs in place. You're going to need a trustee. A lot going on there. Attorneys specialize in this, so it's not without its complications, but it can be a very powerful tool. C Corp owners in particular, can again defer or even eliminate taxable gain on the sale of stock to an ESOP, assuming they reinvest those proceeds in what's called qualified replacement stock or investments, which basically is stocks and bonds of U.S. companies. So you can achieve, kind of this permanent tax deferral. And then S Corps can become partial or fully non-taxable with an ESOP ownership, right? Because if the ESOP owns 100% of the stock in the S Corp, that's the only owner, it's a fully non-taxable entity. So it's a pretty powerful tool. It takes a little bit to put it in place. You got to, do a feasibility study and make sure it's a good fit. The best companies, have some employee girth, if you will. I mean, smaller companies probably don't make sense for an ESOP. Consistent cash flow is probably speaking to the choir here, but consistent cash flow is always a good thing to have as you set up an ESOP for companies that want to do that.
So Tom, one of the questions we got early on was is the ESOP option really beneficial to the employees? So I guess what they're trying to get at is obviously there's some tax benefits to the seller, but is there truly a benefit to the employees?
Well, excuse me. Well, it's clearly a additional retirement plan, right? I mean, there's different ways to structure ESOPs, but typically we see where it's simply the owner sells stock and the employee over time as they stay at the company and fully vest in ESOP, they build up a secondary retirement plan. It's extremely powerful for them and their family and building wealth. And there's some just incredible stories out there of people really companies do well and they continue to grow in value. And so absolutely, it's a great benefit for employees. And for the local communities, what I like about ESOPs is, it keeps the wealth and the business in the local community. And there's so many small communities across the country that the business owner has to make, the difficult decision. And a lot of times when they sell that business to an outside buyer, there's a consolidation that happens in that community. Sort of loses that wealth, right? Because they move the jobs to a different community. So there's just a lot of intangible benefits to the community, but clearly the employees benefit as well.
Yeah, and I think so my experience with them, there has to be a lot of education to the employees, right? Because they haven't been business owners in the past, and they're kind of getting a piece of paper, and there's questions on whether is that value really there. So a lot of education has to be done. I also think there's a big part of the employee base that you have, and are they going to appreciate it? I'm always tell people if your employees appreciate it, you can tell the difference when you walk into an ESOP-owned company. But sometimes the employees aren't educated properly, or there isn't an appreciation for what is hanging out there. So it kind of gets into like the employee match on a 401k. Some employees are going to put money away even though there's a match. And so those typical type of employees, and typical is probably not the right word, but people that think that way probably aren't going to have the true appreciation for what an ESOP brings to the table. But it can be a huge benefit.
Yeah, it's incredible to watch companies that really manage the ESOP, promote it to their employees. It's just a powerful thing to watch when they issue those certificates and the growth, the success they have. And employees realize, how much additional they have to, for their families. So it can be a good thing. So it's definitely something to look at. The nice thing about ESOPs is I think both sides of the aisle in Congress like ESOPs a lot. And so I don't see this under duress from, potential changes. I only see it getting better. They did pass in the recent tax law that S Corp ESOP owners can get a little bit of a tax deferred benefit starting in 2027. It's been a thing the association been trying to get passed for years, where S Corp owners could sell stock and get their gain deferred from tax, much like C Corp owners. So, I think there's reasonable possibility some of those things could happen. I think it's a very popular benefit, as it does sort of redistribute the value of the company to all the employees.
Okay. All right.
So a couple slides here we'll get through. Just some things to think about before a transaction. We want to think about entity structure. We want to think about gifting, right? We can gift stock to charity and get a benefit of a fair market value, as long as we do it well ahead of any transaction. There's some real opportunities there, but again, this takes time, and you can't just do this in a short window of time. Estate planning, if we have an estate, taxable estate, again, some things we want to think about and do before we get hot and heavy on a transaction. One of the things I really love talking to business owners about is their retirement plan. A lot of business owners don't necessarily understand, that there are some more powerful retirement plans where they can defer more money into. It's a great thing, right? We can get a tax deduction, put it into a cash balance plan, and if you see the tables, the actuarial tables, you'll see that if you're 55 years old, you could put $200,000 to $300,000 in a cash balance plan, and if the census of your employee group works out, you can really weight that contribution to some of the owners or key employees. So, and then state of residence, right? We want to think about state of residence, and obviously there's some states that there's no tax. Can we avoid state tax if we're willing to move and to a state that has lower tax rate or no tax? And then during the transaction, we want to think about the proceeds, the net proceeds, so that we can try to either structure it in a way that's, compensation or more tax friendly. Can we use a retirement plan contribution? Can we consider the timing of the payments, right? If we get a lot of money in one year, we push ourselves in the highest bracket. Can we spread that out over a number of years, take advantage of lower brackets? We accept sort of risk there, right? Because we're really financing that transaction. So that's a consideration. Allocation of purchase price, a big area. We spend a lot of time in trying to figure out how to allocate the purchase price to reduce the overall tax bracket. And then, what we're seeing more and more with private equity is can you roll over some of the equity on a tax deferred basis, and then you capture sort of growth in the second bite of the apple, if you will. And then lastly, post sale considerations. Can we reinvest proceeds in something like a qualified opportunity zone, right, where we can take some of the gain and defer it into that, or do we have any real property? Can we do a like-kind exchange? And then just generally estate planning, right? I mean, we've had a transaction, and now we got to think about how do we preserve those proceeds. So where does that leave us at 1:30? We're hitting it right on the nose here. What I would recommend all of us do is engage our advisors, and not just one time. I think this is an ongoing process. Take inventory, understand, how you're performing, understand whether the tax structure can be improved. Make sure you have all the key agreements in place, buy-sell agreements, key employee agreements, deferred comp agreements for key employees. And engage senior leadership, engage your team in trying to understand where can we improve the performance of the business. I mean, all those things are kind of speak to that. Are you ready for an exit? Secondly, I think if you haven't done a business valuation in a couple of years, it's probably time to do that, to understand what the proceeds might be from the business. And we, as Ray mentioned, a lot of times we combine that with a net proceeds analysis, where we actually take the sale of the business and we run it through a model. We look at paying off debt. We look at the tax implications. We look at any working capital implications. We come down to a net number. This is the number you should expect to get after you exit the business, after we pay all the bills and pay all the investment banker and all the other professionals that will be involved. So that's an important exercise to go through, because that tells you, if you're ready from a financial standpoint. So, give that some thought. I always think that at the end of the year is a good time to reflect and think about, what next year might look like, and how much longer do we want to, stay engaged in the business.
All right, I think we're there.
And that's it. So thank you very much. I was looking here for, if there's any questions we haven't answered, we'll cover those after the program. But a couple little housekeeping things here. Complete the survey that pops up right after the webinar, if you would be so kind, to receive the CPE credit. Our fine folks said that, check out with the conference's ID. You will get a CPE certificate within 1 to 2 weeks after the program, and we'll follow up with you with any questions we didn't answer at the end of the at some point here in the next day or so. So the session was recorded. We did mention that earlier, and we'll be sending out a link to the recording after this. And lastly, on behalf of Ray and Sikich, we appreciate everybody attending today, and wish you a great day.
Thank you.